Hello and welcome. In this course, we will explore accounting for government grants and disclosure of government assistance based on International Accounting Standard 20. IAS 20 deals with how government grants should be accounted for and how government assistance should be disclosed in financial statements. Although it was officially adopted by the International Accounting Standards Board in 2001, its origins go back to 1983, when it was first issued by the International Accounting Standards Committee. Over the years, the standard has seen a few updates to keep it in line with newer developments in financial reporting. These changes were made to ensure it works well alongside other standards related to fair value measurement, financial instruments, and the presentation of financial information. IAS 20 provides guidance on how to handle government grants and the disclosure of government assistance in financial reporting. It is made up of a series of sections that carry equal weight and follow the original format used when it was first introduced. While the standard stands on its own, it should also be considered alongside broader frameworks that guide financial reporting, such as the overall principles of IFRS and the conceptual framework. When there's no specific instruction within IAS 20, companies are encouraged to rely on general rules for setting accounting policies, especially those found in related standards that deal with accounting practices and adjustments. This standard applies to how government grants are accounted for and how different types of government support should be disclosed in financial reports. However, there are a few important exceptions. It does not cover situations where financial statements are adjusted to reflect changing prices or when additional information of that nature is provided. It also excludes government assistance that affects an entity through tax-related benefits, like income tax holidays, investment tax credits, or special depreciation rules. Additionally, the standard doesn't apply when the government is involved as an owner in the business or when the grants relate specifically to agricultural activities, which are handled under a different standard. In the context of this standard, the term government refers not only to national governments, but also to local authorities, government agencies, and other similar organizations, even at the international level. Government assistance means any action taken by a government that is meant to provide a direct economic benefit to a specific business or group of businesses that meet certain conditions. However, it's important to note that this does not include broader measures that affect the overall business environment, like building roads in a region or setting rules that impact competitors. Those are not considered direct assistance under the standard. Government grants are a form of support provided by the government, where resources are transferred to a business in exchange for meeting certain conditions, either based on past actions or future commitments related to its operations. However, some types of assistance are not considered grants, for instance, when it's not possible to assign a clear value to the support or when the transaction is too similar to everyday business dealings with the government. One common type of grant is what's known as a grant related to assets. This means the main requirement is for the business to use the grant to purchase, build, or acquire long-term assets. Sometimes there are extra conditions too, such as rules about the kind of assets that can be bought, where they can be located, or how long they must be kept. Grants related to income refer to government support that isn't tied to the purchase or construction of long-term assets. Instead, these grants are meant to help with the general income or operations of a business. Another form of support is what's called a forgivable loan. This is a loan where the lender agrees to cancel repayment as long as the business meets certain conditions. When measuring government support or any related transactions, the term fair value is often used, which simply means the price that would be received to sell an asset or paid to transfer a liability in a normal market-based transaction at a specific point in time. Government assistance can take many forms, and it often comes with different requirements. Its main goal is usually to encourage businesses to take actions they might not consider otherwise, such as expanding operations, investing in new areas, or hiring more staff. When a business receives government assistance, it can have a big impact on how its financial statements are prepared. There are two main reasons for this. First, if the business has received any resources, there needs to be a clear and appropriate way to account for them. Second, it's important to show how much the business has benefited from this support during the reporting period. This helps make financial statements easier to compare, not just with previous years, but also with other businesses. It's also worth noting that government grants may sometimes be referred to using different terms, such as subsidies, subventions, or premiums. Government grants, including those given in non-cash form but measured at fair value, should only be recorded in the financial statements once there is reasonable confidence that the business will meet all the conditions attached to the grant and that the grant will actually be received. Simply receiving the grant does not automatically prove that these conditions have been or will be satisfied. It's important to ensure both compliance and receipt before recognizing the grant. The way a government grant is received doesn't change how it should be accounted for. Whether the grant comes as a cash payment or as a reduction in the business's debt to the government, the accounting treatment remains the same. Additionally, a forgivable loan from the government is considered a government grant once there is reasonable confidence that the business will meet the conditions needed for the loan to be forgiven. When a government provides a loan with an interest rate below the market level, the benefit of this favorable rate is treated as a government grant. The loan itself is recorded and measured following the rules for financial instruments. The benefit is calculated as the difference between the loan's initial value based on those rules and the actual amount received. This benefit is then accounted for under the government grant standard. In doing so, the business should carefully consider any conditions or obligations it has met or will need to meet to determine the costs that this benefit is intended to cover. After a government grant is recognized, any related contingent liabilities or assets should be handled according to the rules for provisions and contingencies. Government grants are recorded in profit or loss in a way that matches the timing of the expenses they are meant to offset. There are two main methods for accounting for these grants. The first, called the capital approach, records the grant outside of profit or loss. The second, known as the income approach, spreads the recognition of the grant's income over one or more periods in profit or loss. Supporters of the capital approach believe that government grants should be treated as a form of financing. This means they should appear in the statement of financial position rather than in profit or loss as a way to offset expenses. Since these grants do not need to be repaid, they argue that recognizing them outside of profit or loss is the correct approach. They also point out that government grants should not be recorded in profit or loss because they are not earned income. Instead, these grants are incentives provided by the government without any associated costs. Those who support the income approach argue that government grants come from sources other than shareholders, so they should not be recorded directly in equity. Instead, they believe these grants should be recognized in profit or loss during the periods that match the related expenses. They also point out that government grants are rarely given without conditions. The business earns them by fulfilling certain requirements, so the grants should be recorded over the same time frame as the costs they are meant to cover. Additionally, since taxes are treated as expenses, it makes sense to account for government grants, which are part of fiscal policy, in profit or loss as well. A key principle of the income approach is that government grants should be recognized in profit or loss gradually and systematically over the same periods when the related expenses occur. Recording grants as income only when they are received does not align with the accrual accounting principle. Such immediate recognition is acceptable only if it is not possible to allocate the grant to other periods. In most situations, the time periods during which an entity recognizes expenses related to a government grant can be clearly identified. Therefore, grants tied to specific expenses are recorded in profit or loss in the same period as those expenses. Similarly, grants related to assets that depreciate are usually recognized in profit or loss over the same periods and in the same proportions as the depreciation expense on those assets. For grants related to assets that do not depreciate, there may be certain conditions to fulfill. In these cases, the grant is recognized in profit or loss over the time it takes to meet those obligations. For example, a grant of land might require the construction of a building, and the grant would then be recognized over the building's useful life. Sometimes government grants are received as part of a larger package of financial or tax benefits, each with different conditions attached. In these cases, it's important to carefully identify which conditions relate to specific costs and expenses, as this affects the periods over which the grant is recognized. It might be necessary to allocate different parts of the grant using different methods. If a grant is received to compensate for expenses or losses that have already happened, or to provide immediate financial support without any future related costs, then it should be recognized in profit or loss during the period it is received. Sometimes, a government grant is provided to offer immediate financial support to an entity rather than as a motivation to make specific expenditures. These grants might be given to a particular entity and not to a wider group of beneficiaries. In such cases, it is appropriate to recognize the grant in profit or loss during the period when the entity becomes eligible to receive it. Proper disclosure should be made to make sure the impact of the grant is clearly understood. Additionally, if a grant is given as compensation for expenses or losses from a previous period, it should also be recognized in profit or loss during the period it is received with suitable disclosure to clarify its effect. Sometimes government grants are provided as non-monetary assets, like land or other resources, for the use of an entity. In these cases, it is common practice to determine the fair value of the asset and to record both the grant and the asset at that fair value. However, an alternative approach that is occasionally used is to record both the asset and the grant at a nominal amount. Government grants related to assets, including non-monetary grants measured at fair value, should be presented in the statement of financial position either by recognizing the grant as deferred income or by deducting the grant from the carrying amount of the asset. Both methods are considered acceptable alternatives for presenting such grants in the financial statements. One method records the government grant as deferred income, which is then recognized in profit or loss systematically over the asset's useful life. The alternative method deducts the grant from the asset's carrying amount, resulting in a reduced depreciation expense that is recognized in profit or loss over the asset's life. The purchase of assets and the receipt of related government grants can significantly impact an entity's cash flows. To provide transparency and show the gross investment in assets, these cash flow movements are often disclosed separately in the statement of cash flows, regardless of whether the grant is deducted from the asset in the statement of financial position. Presentation of grants related to income. Grants related to income are presented within profit or loss. They may be shown separately or grouped under a general heading such as other income. Alternatively, they can be presented by deducting them from the related expense. Supporters of the first method argue that it's not appropriate to net income and expense items. They believe separating the grant from the expense makes it easier to compare with other expenses that are not affected by any grant. On the other hand, supporters of the second method say that the expenses might not have been incurred if the grant wasn't available. So, showing the expense without offsetting the grant could be misleading. When it comes to presenting government grants related to income, there are two acceptable methods. The first method is to show the grant separately as part of income, either on its own or under a general heading like other income. The second method is to deduct the grant from the related expense. Supporters of the first method say it's better not to mix income and expenses, so showing the grant separately helps users compare expenses more clearly. On the other hand, supporters of the second method argue that the expense might not have happened without the grant, so deducting the grant avoids a misleading picture. Both methods are allowed, but it's important to disclose the grant clearly so anyone reading the financial statements understands its effect. Especially if the grant affects any income or expense items that are highlighted separately, disclosing that impact is usually necessary. When a government grant becomes repayable, it is treated as a change in accounting estimate. If the grant relates to income, any repayment should first be applied against any unamortized deferred income that was recognized for the grant. If the repayment is more than the deferred income, or if no deferred income exists, then the repayment is recognized immediately in profit or loss. If the grant relates to an asset, the repayment is recognized by increasing the carrying amount of the asset. Repayment may also involve reducing the deferred income balance by the amount repayable. Any additional depreciation that would have been recognized in profit or loss up to that date, if the grant had not been received, should be recognized immediately in profit or loss. When repayment relates to an asset, it may also be necessary to consider whether the new carrying amount of the asset is impaired. Government assistance is broader than government grants. Some forms of assistance are excluded from the definition of government grants because it's not possible to place a reasonable value on them. For example, free technical or marketing advice or the provision of guarantees are types of assistance that can't be easily measured. Also, some transactions with the government cannot be separated from the entity's normal business activities. For instance, a government procurement policy that leads to part of an entity's sales is considered normal trading, not government assistance. While the benefit from such support might be clear, trying to separate it from regular business transactions would be arbitrary and not practical. Sometimes, even when government assistance can't be measured precisely, the benefit might still be significant. In such cases, it's important to disclose the nature, extent, and duration of that assistance. This helps ensure the financial statements are not misleading. Also, this standard does not consider government assistance to include improvements to general infrastructure, like transport networks, communication systems, or community facilities such as irrigation or water supply. When these benefits are available continuously to the whole local community without a set end date. When it comes to government grants, there are some key things that must be disclosed in the financial statements. First, the accounting policy the entity has adopted for government grants should be clearly explained. This includes how the grants are presented in the financial statements. Second, the nature and extent of the government grants recognized should be disclosed. Also, the entity should mention any other types of government assistance it has directly benefited from. Finally, any unfulfilled conditions or other contingencies related to the government assistance that has been recognized must be disclosed. When an entity adopts this standard for the first time, it needs to do two things. First, it must comply with the disclosure requirements, where appropriate. Second, it has two options to apply the standard. It can either adjust its financial statements to reflect the change in accounting policy following the rules in IAS 8, or it can apply the new accounting rules only to grants that become receivable or repayable after the standard's effective date. This standard applies to financial statements for periods starting on or after January 1st, 1984. Later, IAS 1 was revised in 2007, updating the terminology used throughout IFRSs and adding a new paragraph, 29A. Entities must apply these IAS 1 amendments for annual periods starting on or after January 1st, 2009. If an entity applies the revised IAS 1 earlier than that, then the amendments should be applied for that earlier period as well. Paragraph 37 was deleted, and paragraph 10A was added through the improvements to IFRSs issued in May 2008. Entities must apply these amendments from January 1st, 2009 onward, but earlier application is allowed. If an entity applies the amendments early, it must disclose that fact. Also, IFRS 13, issued in May 2011, changed the definition of fair value in paragraph 3. Entities should apply this change when they start applying IFRS 13. In June 2011, the amendments to IAS 1 on the presentation of items of other comprehensive income changed paragraph 29 and removed paragraph 29A. Entities apply these changes whenever they apply the updated IAS 1 from June 2011. Later, IFRS 9, issued in July 2014, amended paragraph 10A and deleted paragraphs 44 and 47. Entities apply these changes when they apply IFRS 9. Thank you for completing our course and for the attention and dedication you've shown throughout. We are happy to have contributed to your professional development and encourage you to help us improve by providing your feedback. If you have any questions or suggestions, feel free to reach out via email at info@qlever.al or through the contact forms on our website. Also, we invite you to follow us on social media and our YouTube channel to stay updated on upcoming training sessions. Thank you once again, and we look forward to seeing you in our future courses.